Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by my company, Bull Realty. For asset and occupancy solutions, visit bullrealty.com or give me a call. Well, today we're talking about the Fed's view on commercial real estate. We have Brian Bailey here in Studio One. He's a subject matter expert on commercial real estate for the Fed. And Brian, we're talking about some of the underwriting and some of the sectors and things. So, you know, one thing I've noticed when I interview economists and analysts, and I ask about how long we're going to have these good times, no one seems to want to go past like 18 or 24 months. You know, how does that sound to you? I mean, I want it to last longer.
Right. Well, you know, unfortunately, I left my crystal ball at home, Michael. So I'm going to join. That crowd.
Yeah.
But I think, you know, it's fascinating to me if we take a step back and we look back, you know, 2 years. You know, we had a number of folks saying, gosh, I think 2018, the end of 18 or 19 is when we're going to start hitting, you know, a little bit of the chop. And yet you look today and the numbers are very, very strong. So, I mean, I would just say, you know, their crystal ball is probably good as mine and really as good as yours in that, you know, I mean, it tends to look 2 years out and then things get, you know, much more uncertain and nobody really knows.
Well, my crystal ball might be a little rosy colored. You know, I imagine with the Fed, yours might be a little more, you know, cautious.
I've burned mine out. It doesn't work anymore.
Yeah, you know, and you're right. You know, as you've mentioned, you know, the numbers are great. GDP, unemployment's growth, the stock market's great. You know, consumer confidence is good. Small business are positive about the future. What could be headwinds? What could cause the tide to change?
Absolutely. I mean, you know, I would just have to take it back and you know, look at, you know, the question of, you know, from the banking perspective, which is where, you know, my expertise is, you know, do we get ahead of ourselves? Do we see, you know, over leverage? I mean, you know, we've kind of hit this bottom as far as rates are concerned, and now we're in a rising rate environment. And have we properly, you know, prepared ourselves, you know, for the implications of that dynamic? You know, some things that could go wrong. I mean, these are big what ifs. But I mean, you think about it. I mean, you know, 2 or 3 years ago, you know, you had a lot of money that was low rates. And I think that some of those, you know, and we'll back up, you know, some of that money was very low rate, had low rates attached. And did those institutions go long with that money? Because, I mean, if you're looking today, if the 10-year is 3.23 and they went, you know, 4% on that money, it won't take much, you know, for them to be below the yield on the 10-year Treasury. You know, okay. I mean, potentially over leverage, potentially valuation, potentially, you know, structure could begin to become a problem if you get, you know, a lot of competitive firms and they basically tell their customers, hey, we are so interested in making this loan, you just name your terms. Okay, you know, that doesn't work terribly well in my book. I'm kind of wondering, how do you make money if you just say, name your own terms? Yeah. You know, I think some of the other things too, you know, we tend to kind of come up with, you know, different financial products, whether it's derivatives or, you know, collateralized loan obligations, or it was the CDOs in the past, in the mid-2000s that had, you know, significant problems. You know, and have we, you know, appropriately gauged the risk around some of those new products, or, you know, do they begin to kind of get wound up and spin out of control at some point?
Yeah. Well, how do you feel about inflation? It seems like we've seen, you know, home prices go up. It seems like whenever I go buy anything, it seems like it's that expensive? You're kidding me? Construction prices going up. And the Fed, I'm sure, watches inflation, right? What do you feel about inflation?
I mean, we spend a significant amount of time, watching inflation.
Yeah.
As the commercial real estate guy, I can't tell you outside of my area of expertise, how inflation is doing. I defer to our president, who spends his full-time job looking at inflation. And right now I think that, there's a level of comfort from his perspective as far as, where inflation is, and because of some of the robust dynamics in the economy, we have, an opportunity to kind of, move toward, a rate, an interest rate that's, environment that's neutral.
Yeah. What about tariffs? What do you feel about tariffs and the impact on the economy and commercial real estate?
I mean, that's a tough dynamic. I mean, we see, we begin to see some of the impacts in pricing. You've seen steel go up, and some of the impact, which we already had costs rising at a pretty good clip, and it had created a headwind in a number of industries. So certainly, and we talked about office space, that's one of them. I mean, as you go into the CBD, the higher the tower, the more steel that it needs. And so certainly I think that it's created a headwind on, some potential new construction of that class and classes that need, significant amounts of steel. So on one hand, a good dynamic because we've limited the potential of oversupply. At the same point, you want a kind of a balanced market where, rents are not growing, significantly because of, potential shortages of new product. As our president has said, trade wars very difficult to win. We've not seen the full impact of what tariffs are going to be levied. Additionally, we've not seen probably the full impact because the ones that have been levied are so new on the supply chain.
Yeah. And speaking of full impact, have we really seen the full impact of the tax cuts? I mean, I know they've kind of hit this year, beginning of the year, but is there more to come? Are there more benefits from that? Could that maybe potentially prolong the good times?
I mean, there's a very tough question to answer, but I think that we still have some time for the full impact of those tax cuts. To certainly in the short term, it's put more money in a number of people's pocket, which has been good for the economy as far as a spending dynamic. But I think that yes, longer term, we don't know the full benefits of that legislation. Yeah.
Well, Brian, what would you leave our audience with related to commercial real estate moving forward?
I mean, I think it's an exciting time. I mean, you have a very good economy. You have dynamics in the commercial real estate space that, for all purposes, are healthy. I mean, we might have a little bit of oversupply dynamic in luxury multifamily. We might have a little bit of softness right now in some forms of retail. The rate of change is changing pretty fast, so something to stay aware of. I think, my view is we continue to watch, the capital dynamic right now. And, certainly there is a lot of capital available. And certainly that has implications for debt. That may make debt cheaper for a lot of folks who need loans in the commercial real estate space. May, in the short term, benefit them because of competition, over competition. They may be able to get structure and terms that they've not been able to get. At the same point, you have to watch longer term, are those, right for your situation? I mean, I think we saw some banks that advanced, and as an example, you go back to the mid-2000s, and we had some banks that advanced too much debt, which created, when the economy turned, an over-leveraged situation for that borrower. And so I think, trying to right-size, the amount of debt and those terms, for your situation is key at this point.
Yeah, and like you said earlier, though, I think the debt market was a lot different then. It seems like the underwriting was too relaxed. And we helped a lot of borrowers and lenders and banks with troubled loans and REO and selling notes and handling workouts. And there was a lot of mess created there. I think there was some sloppiness in the loans that were being done, and in the 90s, and I mean I think it's or in the early 2000s before the '09 debacle, right? And we saw some of the banks what they had and didn't have in the underwriting, and it was like, really? But I don't think, it seems like it's been a lot different. It seems like it's really been cleaned up.
So I was at a conference the other day, and they were arguing that this happens every 10 years, period. Yeah. And I said, I can't quite buy that. Yes, there are some kind of historical omens that, yes, we hit, mid 2000s and we hit the 90s, and so. But I do think that, from the bank's perspective, the regulation has helped them kind of, take a moment and assess risk better. I think they are better capitalized. At the same point, the risks change, and some of the risk is coming, from the non-bank sector in my mind right now.
Yeah, and it seems like too they understand real estate better. I think when I look back before '09, it's like, and I looked at some of the loans and some of the projects that they did, I was like, they didn't really understand real estate very well. And as we came and they started owning real estate, then I realized they definitely don't know real estate. I think now they seem to know it, and in part maybe because of this show, maybe because there's more, there's more transparency everywhere, right? And for things and you going out and speaking and let them know more about real estate, I think that's all been helpful.
I think thank you, and I think that's a great point. Mm-hmm. I mean, we have seen some banks that have really, heightened their game in the commercial real estate space, and really it should, because commercial real estate is a capital intensive asset. It's in the sweet spot for banks, and really you should know it inside and out before advancing 50% or 75% on that asset, which usually runs into the millions.
Yeah. Well, good point. Brian, thank you for joining us. Good information as usual.
Thank you, Michael. I appreciate being here.
Yes, and thank you for joining us. We appreciate you sharing the show and your comments. Let us know what you think, and be sure and join us next week. Until then, make sure you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show.